Today, I will tell you how to invest in real estate with no money and bad credit. Let's have a look at the details. First, investment property mortgages require a down payment, typically 20% to 25%. For example, say you want to buy a $250,000 investment property. With a traditional mortgage, you need at least $50,000 cash as a down payment. That's a lot of money. And most new investors just won't have that sort of cash sitting in the bank. On the other hand, the second major challenge to using traditional mortgages involves credit. For better or worse, people judge us by our credit. Landlords, banks, and credit cards, among others, view us through the lens of our credit scores. If you have good credit, people deem you a reliable borrower. Conversely, bad credit leads many people to categorize you as unreliable or, at worst, untrustworthy. If you have bad credit, most traditional lenders will not provide you with a loan. This video will solve both those issues. The first step is to raise money by bird dogging and wholesaling. Bird doggers spend their time looking for a certain sort of deal. They want to find distressed properties that won't qualify for traditional financing. In other words, traditional mortgage lenders want to make sure a house is actually habitable. Bird doggers look for properties that don't meet this standard. Next, the owners of these properties need to have some equity in the property and some reason for wanting to sell, often to turn that equity into cash. As bird doggers find leads in situations like this, they pass them along to wholesalers for a fee. They may receive a fee for every lead, or it could be a contingent payment based on the lead actually converting. It ultimately depends on the relationship you have with a particular wholesaler. But, regardless of payment structure, bird dogging provides you an outstanding opportunity to gain some real estate investing experience with little to no barrier to entry. Once you've bird dogged for a while, you can make the jump into wholesaling properties yourself. This investment strategy lets you make money without needing to actually purchase properties. Instead, wholesalers find off-market properties, and they enter contracts to purchase these properties. Rather than close on the purchases, they assign the contracts to a third party, typically a fix and flip investor. And they assign these contracts for a fee. As such, wholesalers find deals, connect the sellers with investors, and collect a fee in the process, all without dealing with the headaches of doing any rehab work themselves. The second step is to use profits to improve credit score. Start improving your score as soon as possible. It can take a while to see results, so the earlier you start, the better. And improving your score will open more investment opportunities in the future. To do that, you can request a free copy of your credit report from any of the major credit bureaus. This report will outline the major items hurting your credit score. You can use this report to gradually improve your score. But, for most people, you need to do two things to improve your score: pay your bills on time, and pay down your outstanding debt. The third step is to increase margins by flipping houses. When you fix and flip a house, you inherently buy real estate. But with these deals, you only hold a property for a limited period of time before reselling it at a profit. To do it, investors need to find properties that need rehab work to qualify for traditional financing. And these properties need to make financial sense. That is, the purchase price and all rehab-related costs need to be less than the projected final sale price to make a profit. After purchasing a distressed property, house flippers need to renovate it to a standard that qualifies for a traditional mortgage and appeals to potential buyers in that particular market. This requires an in-depth understanding of renovations, working with contractors, and creating accurate rehab budgets. Finally, house flippers need to sell the property. Typically, these investors sell to primary home buyers. That is, they sell to people looking to buy their home, not an investment property. This requires an understanding of sales and pricing strategies, and a solid analysis of the local market. The fourth step is to continue using profits to improve credit score. According to the credit reporting agencies, two factors make up 65% of your credit score: 1. Payment history, 35%, and 2. Amounts owed, 30%. Using your wholesaling and bird dogging profits, you should at least be able to focus on that first factor, paying your bills on time. That is, if you have credit card debt, a personal loan, or any other sort of outstanding credit, make sure to pay the bills on time. But that's only half the battle. To really start improving your credit score, you need to seriously pay down the amount of debt you have outstanding, as this makes up another 30% of your credit score. The fifth step is to buy real estate with the BRRR strategy. After gaining experience, cash, and improved credit in the fix and flip world, investors who want to buy real estate to hold usually make the jump into the BRRR strategy. In short, the BRRR strategy combines buy, rehab, rent, and refinance. The sixth step is to begin to buy and hold investing. The more investment properties you own, the more rental cash you receive on a monthly basis. However, investors also often get to the point where they no longer want to deal with the hassles and effort of rehabbing a BRRR property. Enter the buy and hold strategy. With buy and hold real estate, you have the same endpoint as a BRRR deal, that is, an income-producing property. Thanks for watching our video. Please don't forget to subscribe to our channel.